This is Chris Carlson, and welcome to the Boulder Banking Podcast. My guest is Don Musso, president at FinPro. Don is a sought-after speaker at conferences all across the globe and has been on the faculty of multiple banking schools, to include GSBC. This was a fascinating conversation in which Don pulled no punches as we discussed the economy, the Fed, bank regulation, ESG, and cryptocurrency. Don, thanks for joining us today.
Well, Chris, thank you for having me. I look forward to having this conversation.
Don, there's so much I want to ask you today, but before we get started, can you give us a brief background of Don Musso?
Sure. I've been in banking for a little over 40 years. I'm a thought leader in the community banking space. We do a lot of work with the policymakers in Washington. I'm particularly proud of our community outreach and that we teach at major banking schools like the Graduate School of Banking in Colorado. And in general, I'm just a fun-loving guy.
That's the rumor on the streets, Don. Hey, Don, tell us about FinPro.
Well, it's hard for me to believe, but I started FinPro back in 1987. So we've been around now for 35 years. And FinPro is a consulting, regulatory, and digital firm, and we have our own broker-dealer as well. So really a four-legged stool. We've got a couple hundred community bank clients. We're covering 42 states, and we have some large international clients like the State Bank of India.
Is there anything particular that you tend to specialize with when you're working with those community banks?
Yeah, our firm does, as I said, a lot of regulatory work, and we've got a bunch of heavy-hitting ex-regulators on staff to do that. I tend to focus on strategy and capital markets. And then we've got other folks who focus on asset liability management. We have folks that focus on market feasibility, enterprise risk. Pretty much, if it moves in the community banking space, we're in it in some way, shape, or form.
Thanks for that explanation. Hey, Don, let me ask you this. I want to get into the meat of the matter. How would you describe the general state of the economy as we sit here today?
So, Chris, I'm not a guy that is overly political. As I like to tell people, I don't like Democrats. I don't like Republicans. I don't like independents. I'm from New Jersey. I pretty much don't like anybody. But, the real world is that the economy is being run into the ground by clueless leaders of both parties. They're taking what should have been an incredibly good, strong bull run, and they're cutting the lifeblood right out of it. And there's just a whole host of reasons, but it's namely that they haven't been responsive to the market and the market demand. We saw inflation starting last summer, and we should have nipped it in the bud in the fall. And only now have they started to raise rates. So I'm pretty pessimistic on the economy.
Do you see light at the end of the tunnel? And is it light or is it an oncoming train?
Well, I've been telling all of our clients, Chris, that we're looking at a fork in the road right now. And it could go either way. I look at the economy and I say, well, GDP is strong because there's pent-up consumer demand, and consumer demand makes up about 2/3 of the economy. So if we can keep the consumer in the game, I think we've got a pretty good shot of having a decent 2022. But then, when I take my eyes off of the consumer game just for a minute, I start to see the Fed raising rates, and they always tend to overdo it. I see inflation that's out of control. I see a supply chain disruption that doesn't seem to end. I see a U.S. debt and deficit that nobody seems to have the stomach to corral. And now, the latest is I think we've got significant staffing shortages, and I think that's going to add to the cost burden. And I think it's ultimately going to hurt the economy. So, yeah, it's a tough market right now.
Don, I found something interesting that FinPro has coined the phrase, the workerless recovery. What does that mean?
Well, starting back in the fall of last year, we were listening to all of our political friends tell us that we had inflation that was transitory and that, the workers were all going to come back into the workforce. And that what we really had was an unemployment problem that was triggered by COVID. And that all of our problems would go away once COVID kind of lightened up and everybody could go back into the workforce. Well, that's not really what happened. What's happened is business has come back because, as I said earlier, consumer demand is strong. But we haven't seen workers returning into the workplace at the rate we thought we would. And so that's led us to full employment. We have very little unemployment right now. It's not that, we have workers that are looking for jobs. It's just the opposite. It's that we've got workers who can't find workers. And so we've got a significant problem right now. And it makes it all the more amazing that we've been able to have this economy as strong as it is, considering that we were in COVID, we came out of COVID, and we have not had a return of the workforce. So the workless recovery really talks to the fact that right now, this labor shortage is going to make this an absolute worker environment probably for the next 2 to 3 years.
Good time to be a worker.
Great time to be a worker. We're not only talking about compensation, we're talking about things like working remote and flex time and all that as well. And I think that's now become the norm. I don't see us returning to the pre-COVID times.
Yeah, it reminds me of the expression, Don, what was once a luxury is now a necessity.
Yeah, absolutely. And any employer that doesn't want to play in that game isn't going to have any employees.
Well, Don, you mentioned this briefly before, but let me ask you specifically, how do you feel the Fed has handled the economy?
Well, I'm going to address that directly, and then I'd like to just add a comment to it. I think the Fed waited too long. I mean, that's really the straight shot. They should have started raising rates gently back in the fall of 2021, maybe as early as September, when we saw inflation rearing its ugly head, and there were many people at our firm and other places that were calling it not transitory, but in fact a much bigger problem. By waiting, they let inflation just get way out ahead of us on its skis, and now they're going to have to compensate for that by a couple of 50 basis point raises. And we're doing that while we've got this black swan event going on in Ukraine, and while we still have the supply chain disruption that really has not abated, and we don't see it abating until maybe early 23. But I think there's another problem in hand here, and that is that the Biden administration, for whatever reason, just doesn't seem to want to appoint Federal Reserve presidents. I mean, we're down a couple of Fed presidents. We have, as of now, we still don't have a official Randy Quarles replacement, somebody in charge of safety and soundness at the Fed. I know that they had a couple of people that they test drove, and neither one of them made it. And I know that they, have another potential name that they ventured forth today. But when I look at it, and I think he's got to get key appointees in place so that the Fed can operate the way the Fed traditionally operates. I also think that things like cryptocurrency have really tied the Fed's hands because they don't control the money supply the way they used to. Because they have zero control over the cryptocurrency markets.
So you talked about Biden not appointing these people. Is it they're just not taking the initiative, or are they just afraid of the other side of the aisle continuing to maybe not approve who he's putting forward?
Unfortunately, I think it's both. I do think that his appointments have been a little bit extreme on the left, but I also think that the Republicans have taken the view that we're not going to help him in any way, shape, or form appoint anybody. So, I think it's a little bit of both. And it's kind of a shame that we've gotten to this stage where both parties would rather vote what's best for their party than vote what's best for the U.S. economy.
Don, I know that you spend a lot of time studying demographics. How is demographics affecting or will affect the economy?
Well, we're going to go through the biggest wealth exchange ever in history as baby boomers all retire and as we start to experience life events. And the question is, what is the next generation going to do with this newly acquired wealth? And it's clear to me they're not going to follow the traditional norms. They're not going to leave it in the bank where mom and dad had it. They're not necessarily going to leave it with the asset management firms, the Morgan Stanleys and those types of players. So I think we're going to see a dramatic shift in the way the financial markets work and operate. And I think it's probably in some ways good. I mean, I think it's probably time that, we caught up and got into the 22nd century. When I look at our clients in Europe and I look at our clients in Asia, they are so far ahead of us on the technological spectrum and in meeting consumer needs. And I kind of say to myself, how can that happen? The U.S. has always been a front runner. How did we get this far behind? But I think demographics is going to force the change. I think we're going to have to catch up. I also think, due to immigration and the like, I mean, we really have become a true melting pot again. And I think that that's going to cause us to stop and rethink how we do what used to be considered traditional banking. And so I think we're about to go through a change like we've never seen before.
Don, you mentioned something that's very interesting. What are one or two things, or maybe one or two reasons why the U.S. is so far behind these other countries when it comes to the technology?
I think by and large, what happened is in the United States, in the banking space in particular, we had an oligarch system. And really, all of the IT providers consolidated in the 70s, 80s, and 90s. And we really only had three left. We had Jack Henry, we had Fiserv, and we had FSI. And they controlled probably 85+% of the entire banking market in the United States. And they really didn't have any incentive to open up their systems to through API to other kind of new wave technologies. They would rather, they wanted to keep it intact and they wanted to maximize profits to themselves. And in so doing, they significantly retarded the technological growth in the financial services sector. And so now what's happening is we've got all these new fintech firms that are entering the space with technology that's 10 times faster, 10 times better than the platforms the oligarchs are running on. And now the oligarchs are going to have to catch up really quick. Or we're going to find all of the financial institutions across the United States slowly converting off of the oligarch systems onto, for example, cloud-based platforms where they can utilize any technology and connect into any software provider that they want to.
It seems as though so many other industries made the change easily, and yet, to your point, it seems like the banking industry has been so resistant to doing these things.
Chris, it kind of makes you wonder whether or not being a highly regulated entity is helpful or hurtful, right? I mean, maybe part of the change is that we're so the slow pace of change is that we're so heavily regulated that we just can't get out of our own way.
Speaking of that, what should banks be expecting in terms of regulation?
I think regulation follows the political will of the leadership. So I think it's going to adopt the Biden administration's consumer-oriented, heavy compliance burden kind of an approach. So we expect here at FinPro a wave of new consumer protectionist regulations to come about. You're already seeing that in their attack on certain bank fees. They've been after overdraft fees now for a number of years, but they're talking about looking at some other fees that banks provide and charge as well. And so I think we're going to see, at least for the next a year, and this might change with the election in November, but it'll take at least until January or February for the new group to take power. And during that period of time, I think we're going to see a significant shift towards what I call the Liz Warren end of the spectrum. Heavy consumer compliance.
And when it comes to a community bank, how difficult it is, maybe if nothing else from a cost standpoint, to deal with that compliance?
It's extremely costly. I mean, remember, we're not only adding people, which we seem to be doing every year, but we're having to buy the latest and greatest systems that we're benchmarking to. And nobody wants to be the one that's a generation behind, particularly in things like cybersecurity. I was at a conference not so long ago where there was a Fed analyst who was saying that we could see well over 50% of the banks in the country hit with some form of cyber attack. Now, that could be just a privacy, an information attack, but it could be a lot stronger. It could be ransomware. It could be, that their systems are just completely hijacked and shut down. It's a pretty scary time. So, when I look at it, I think we're kind of in this mode right now where we're going to have to continue to spend a lot of money just to stay current. And if you're a smaller bank, let's say under 500 million, you just don't have the wherewithal financially to do that, nor do you have the bench depth to keep up with this wave of new regulation and this wave of technological change. So it's going to be challenging.
So you hear the politicians rail against the big banks, but yet they have all this regulation really putting the squeeze to the small banks. Are they almost competing against themselves?
Yeah, there's definitely cross signals going on in Washington, and I'm not sure that that's going to get solved anytime soon. We really need a bifurcated system between the bigger banks and the small banks. The small banks aren't in half of the business lines that the big banks are in, and we don't have half of the global risks that the big banks have. So we really need to have two sets of rules. One, I think, for the really large banks, and one for the rest of the community banking space. And I've heard, from a number of different regulators, they'll all tell you to your face, well, we really want to protect community banking. And yet every move they've made until recently has been promoting mergers, not discouraging it. It's really only been in 2022. It's only recently that the agencies have started to look at mergers and acquisitions and say, well, time out. Maybe M&A is not the best thing for this industry. And I'm like, duh. Every time there's a consolidation in the industry, it's one less bank, and it's one less bank for you to regulate. So, if we looked at the number of people in the regulatory space and did it on a per bank average basis, the regulators should all be downsizing right now. And I think that's getting their attention.
Well, Don, I got kind of an outlier question for you. How big an impact will ESG have on the banking industry?
Well, it's going to be huge, but I will tell you that in my mind, at least our clients, the vast majority of them are in fairly good shape. We all have female representation on our board. We've got a lot of minority representation on our boards, but it's going to become more and more pronounced. And where I start to worry is when they start to take ESG out of the pure governance world and they start to move it into more of the managerial aspect. Are we promoting enough women and minorities, to the right levels? And do we have equal pay, and do we have all this, and compiling all the statistics and the reporting that goes around that? So I think it's going to be a big event, not just in banking, but in every industry. But I'm pretty proud of what community bankers in particular, have done to date. I think they've done a pretty good job at diversifying their boards and their senior management teams.
Well, Don, earlier you mentioned fintech. What will be the biggest impact technology will have on the banking industry in the months and years to come?
So I think, similar to all other industries, I think it's going to be the removal of the need for entry-level workers. I think entry-level workers are going to be replaced with artificial intelligence, potentially robots, and other forms of technology. I also think, similar to other industries, we're not going to see the mom and pop branches all over the country as we have. We're going to kind of see a consolidation of branches to more of a hub and spoke approach. So I think it's going to have a very material impact. And banks are going to be forced into it because as spreads and margins tighten, we are going to have to cut costs if we want to maintain any kind of profitability for our shareholders. So I really expect that we're going to see a material drive for technology through 2025. And then I think it'll start to flatten out a little bit as we kind of absorb all the change that we've just gone through.
What will be some of the positive impacts technology is going to have on the banking industry?
Oh, I think we're going to have much more information available at our fingertips, much faster than we've ever had it before, to be able to make decisions. So, and I think we're going to be very nimble as an industry. We're not going to be bureaucratic. I think it's going to help us answer questions for our customers, to give advice, financial advice to our customers. So I think we're going through a pretty big financial revolution, and it's going to be driven by technology.
When you look at your crystal ball, what kind of impact is it going to have on the number of banks that will be remaining?
So we're already down to about 4,500. I show you how old I am. We had 18,000 banks when I started 40 years ago. So from 18,000, we're down to 4,500. And it wouldn't surprise me in the least by 2025 if we were down around 3,000. And I don't think we're going to see a lot of small family-owned banks or the small rural banks. I think it's going to mostly be banks that are 500 million and up. I mean, there'll be a few startups that'll be sprinkled here and there, But by and large, it's going to be a much smaller count, and they're going to be bigger banks.
Well, Don, given all that, what should banks be thinking in terms of their balance sheets today?
This is it's a fascinating question, because now we got to tie that back to the first question you asked about the economy. And if we're going to have a strong economy, let's call it a GDP of 2.5% to 3%, and we're going to continue to have higher inflation, and we're going to continue to have strong consumer demand, I think we're going to have a continued surge in deposits, but I think we're going to have loan demand that's going to strengthen. So I think overall it'll be good for the net interest side of the business. Conversely, if we go into a recession or are driven there by the Federal Reserve, loan demand will dry up real fast. Deposits will slow down, but I don't see them shrinking. And that's going to cause a real tailspin in spread and margin. There's one other balance sheet kind of fascinating thing to look at right now, and that is that the ALLL, allowance for loan and lease losses, now it's called ACL with the advent of CECL. As all the public banks started to adopt CECL, they all pumped a ton of loan loss allowance in through their provisions. That was all in the first quarter of 2021. Then for the last 3 quarters of 2021, they recaptured all of it. So it just kind of goes to show you that either A, nobody understands CECL and we don't know how to compute it, or more likely B, CECL is really a colossal waste of time and money, and we're not getting any better answers, because we have much more volatility now than we ever had pre-adoption of CECL. So I'm expecting strong deposits. I'm expecting loans may stay strong, but could weaken depending on the recession. And I think we're going to continue to see some volatility in the whole credit side of the business.
Well, what else should banks be thinking and or doing at this point?
I think every bank's got to figure out where they're going to play in the fintech space, i.e. in payments. They've got to make decisions on whether or not they're going to get into cryptocurrency. Last week the FDIC came out and said, hey, any bank that's thinking about getting into the crypto space better contact us first. So I think that's an admission that the FDIC sees a wave coming. I think barring the House and Senate passing laws legalizing marijuana, I think we're going to continue to see some opportunities in the cannabis space. I think a lot of banks are talking about getting into the wealth market. They see this transformation of wealth coming, but they're not really sure what to do about it. And I really haven't seen well thought out strategies around that yet. So I think we're going to see a drive for fee income through third parties. I don't know how much of it will be self-driven. I think most will be partnering with other providers. And then I think you're going to see a wholesale effort to cut expenses through automation predominantly.
Well, you mentioned crypto. How confident are you that our regulators have any idea on how to make this work?
That's an area I have zero confidence. And it seems to me like they're all punting. It seems like none of them really want to be the regulator of choice for crypto. And we got to remember we get 2 types of crypto. We've got stablecoin, which are tied to various currencies, and then we have the more risky Bitcoin of the world that's really not tied to any currency. It's a self-standing, self-mined form of money. When I look at the crypto market, I think the adoption is going to continue at a relatively quick pace, and it's going to force the hand of the Fed. And I keep saying every chance I get, and every time I give a speech where there's Fed members at it, I warn them, if cryptocurrency gets too big and you're not the regulator of choice, how are you going to manifest, your mission, which is basically through the money supply, controlling rates and controlling inflation and things like that? I don't see how they can do that if they don't control the money supply, and they're not going to control the cryptocurrency supply. So I think we're going to face a very interesting conundrum here sooner than people think.
Well, Don, I tell you what, we need to get you back on in a future episode. Let's just talk strictly crypto, the good, bad, and the ugly.
Yeah, I would love to do that. I would tell you that of our 300 some odd clients, well over half are actively looking at. We've got half a dozen that are in it, but half are looking at it right now as a strategy for 2022.
Well, Don, you have given us some great nuggets. If anybody has any questions, what's the best way for them to contact you?
Probably the best way would be to email me at dmusso, MUSSO, at FinPro, FINPRO.US, or they could call my office at 908-613-7410.
Don, I know you got a lot going on. I really appreciate you taking time out of your busy schedule to visit with us today.
Chris, I welcome the opportunity, and I thank you for all that you do.
Thanks, now.